Hello, I'm your host, Michael Browne, and welcome to the latest Macro Moments podcast from the Franklin Templeton Institute. Today, I am joined by Jo Rands, our UK equity fund manager from Clearbridge, and David Zahn, head of Europe for Franklin Templeton Fixed Income. We're here to talk about the new UK government, led by Andy Burnham, who became Prime Minister yesterday. What can it do? What will it do? And mostly, what impact will it have on markets? Where do we see the opportunity? Can Andy Burnham deliver economic change without triggering a market revolt? Is there anything a Burnham government could do to change the outlook for UK equities and bonds? So we have a new Chancellor, John Healey, a very well-respected political heavyweight. He has been around several blocks. He's the oldest Chancellor, person to become Chancellor, I believe, since the 19th century. We see sweeping changes across the cabinet. 11 members of the old Starmer team, who does like his football, have been dropped and replaced by names that many of us will remember from the Blair and Browne years. But David, is this a case of old wine in new bottles, or is it a case of being reassured that we are dealing with known knowns?
I think in general, he wanted to reshuffle his entire cabinet because he didn't want to be seen that any Starmerites were left. And bringing in some people who have experience at change in government probably makes sense. But I do think that the driver is going to be himself. He's the one who's going to drive what change happens, and then he wants people who can implement that. And so I think that is, yes, we have people from previous administrations, but I would take no mistake that this is definitely a new direction that this government wants to go in.
It's been very obvious sitting here in London that this is a cabinet made up of MPs from north of the Trent, if I can put it that way. What's the reaction in Yorkshire this morning?
I think, yeah, it's a reassuring message that we have got some experienced figures who know how the government works so they can hit the ground running. As David says, really, yeah, we're going to really see the real test is going to be, are we going to get some fresh ideas? And really, they're going to be judged on the delivery, not on their CVs.
And I think that's where you look through the list of cabinet members and we'll pick out John Healey, but I would also pick out Emma Reynolds, who are experienced politicians who have been around the block, who know how to negotiate. That's a very clear message from this cabinet overall. Yeah, so what's your reaction to this morning's news, Joe? Then we've got a VAT cut suddenly out of the blue, 6 a.m., up and running.
Yeah, I guess Burnham has been quite clear that he wants to do something to address the cost of living issue and that he wanted to announce something quickly. He wants to get the electorate on his side as well. There's obviously questions as to whether this actually is fully funded, as kind of the implied commentary suggested first thing. It will help inflation a bit, so that's kind of positive that they're taking some action that will help reduce inflation a little, but it is obviously quite short term. We see energy prices move on the back of macro drivers, war in the Middle East, etc. And so really, we're just kind of watch to see the fiscal discipline from here. Burnham has committed to the rules. But yeah, let's just see kind of going forward as to how much flexibility he may want to take, which he has kind of emphasised that may be something he wants to do.
David, what's your thoughts over the balance between spending and being fiscally neutral?
I think in general, he's going to spend, and he's going to spend a lot. I think that given who he's put in as Chancellor, Mr. Healey, that there must have been an agreement that the increase in defense spending will be very, very large. But he also has his social program that he also wants to fund. So when you start looking at the different parts of just those two, you're talking probably between 25 and 30 billion, being very conservative. So it's going to be more than that. I think he's brought in Healey basically to figure out how do we do this? How do we basically bend and stretch the rules? So I think that you will see him pushing to the edge of the envelope, which probably means that gilts will remain with their premium for the foreseeable future until they really demonstrate that they can run the government in a way that's more sustainable.
Yesterday's reaction saw spreads absolutely stable against Germany, and that the market was giving very little away in terms of its view at that particular point in time. But it's also noticeable that sterling's been very strong in the last month.
Yeah, I think sterling is being impacted by other factors besides just this. In addition, we did see a little bit of movement right as the cabinet was being announced yesterday of gilts widening a bit. There was just a lot of unknown. And I think that there will continue to be unknown until we see the budget and really what his 10-year plan is. And really until we see that, I think the gilts will trade probably quite softly relative to Europe.
The sort of thematics that we've had under the Reeve-Starmer period, whereby they've wanted to do things, they found ways of raising the revenue, or after they decided what they wanted to do.
Well, I don't think it's completely a continuation because I think under the Starmer administration, they did it very piecemeal. They found one thing, and then they found something to fund it, and then did it. Whereas I feel that Burnham is going to be much bigger picture. He's going to try to make bigger changes, which probably means that the amounts that will need to be raised will be much larger. And that will be probably more of a challenge for Mr. Healy to figure out where's the cash going to come from.
It comes down to credibility. Will the government remain within the fiscal rules? So you're suggesting it's going to be a hard job to do that, David?
I think they'll remain within the fiscal rules, but there's a lot of flexibility, that they can use. He's talked many times about looking at net debt rather than gross debt, and so whether or not they would bring, if they buy things or build housing, would that go on the balance sheet as kind of an offset? So it actually doesn't increase net debt as much. And also, we still have the get out of jail free with, it's investment. So maybe therefore it doesn't count quite as much, but we'll pay for our, daily stuff. And he wants to do a lot of investment. So I think there will be areas where he'll try to push as much as he can to get as much spending out as he can. So I don't think there's a change there. It's just how does he describe it so that hopefully the gilt market doesn't take it too badly.
Already had big tax rises on the books for 28 and 29. So presumably all of those stay at this particular moment in time, and you start looking for other ways of raising revenue.
Yeah, he's definitely looking for more revenue raising. It's just where will it come from? What areas will he focus on? He wants to, help people as he's tried to with his cut on VAT on electricity bills. But there's also other rumors he may try to put more money into people's pocket just so they feel a bit better, which I think, in general, the economy would benefit from. But it's the question, how is he going to pay for that? Where is the money going to come from? And it seems very unlikely he'll be able to do a lot unless he can kind of tackle entitlements and also the welfare state. And that's been, up till now, something that's not been able to be tackled.
Comes a political question as to whether he's able to corral his backbench MPs in a way that the previous government wasn't able to do so. Jo, we've seen one or two elements here. As David talks about defence and he talks about house building, that would be positive for the equity market in terms of spending priority, surely.
Yes, indeed. So if we look across the sectors this morning as how they've responded to the appointments across the cabinet, we're seeing the defence sector rise. As we've discussed, the chance of greater defence spend now looks significantly higher with Healy appointed as Chancellor. Also, the housing sector has seen a bit of a boost. Again, Healy, he was behind a review which looked as to whether the housing market could do with more demand support about 10 years ago, which could suggest perhaps a kind of help to buy. And also Angela Rayner kind of coming back in as the housing minister as well, I think is just generally seen as quite positive to the housing sector. But of course, interest rates and the outlook there is a key determinant of the sector and how it performs. Utilities kind of seen as slight negative. I think the energy secretary is seen as perhaps kind of a bit of a soft left. Overall, not kind of massive shocks, but I'd say they're the main kind of sector moves that we've seen today on the back of these announcements of appointments.
Let me come back to the house building, because you said something really interesting there, that in a previous live, John Healy has looked at incentives to buy. Now, all of those incentives were removed 14, 15 months ago. The housing market since then has been pretty weak. Volumes have continued to tail down. New build volumes have continued to tail down. Do you think that is the vital spark to reignite the housing market?
I think it would certainly been seen as a big positive. Obviously, demand has been incredibly subdued. I think the signalling from the house builders over the last 12 months with the Labour government would not be interested in a help to buy. So maybe now that's looking slightly more likely. But, certainly borrowing costs have been elevated for some time and kind of interest rates have been taken longer to come down, which has just created a headwind in terms of demand, and just lots of kind of policy uncertainty as well. Talks about changes potentially to stamp duty, etc. It's just not helpful in terms of driving transactions in the housing market. But the sector is certainly on extremely cheap multiples, 0.6 times book value, back at very distressed levels. So there's really not much positivity priced into the sector at the moment.
Let me flip that slightly around as well, Joe, and talk about council houses, because effectively we don't build any council housing anymore. A house builder would take a plot and would take a 20-30% or so and build for social on that basis. But if you want to build 50,000 council houses a year, and the average house cost of a house at the moment is £270,000, that's £13.5 billion a year on house building. That would be quite a boost for the construction industry as a whole, as opposed to just for house builders, wouldn't it?
Yeah, if it happened, I think the market is pretty skeptical as the funding, where that may come from, whether as David was saying, maybe it's some sort of off balance sheet funding, but also just operationally the ability to deliver. Is a skilled labour force there? Are the materials there? It would be very difficult to deliver. But certainly, it would be providing a positive backdrop for the sector, as opposed to a kind of headwind that we have seen over the last few years.
And David, how would the market react if it had a capital injection? So in other words, that this was part of the capital investment budget, not part of the day-to-day budget, and therefore was taken off official national debt statistics.
I'm always very skeptical of politicians that say they don't have to count it because they put it in a different bucket, because it still has to be financed. And the market understand that total debt of a country is what matters. It's not necessarily what's in each individual sleeve. And we've seen many governments globally try to do this, and it never really works because everybody kind of sees straight through it. So I think in general, if they want to issue a lot, then they will have to pay more.
Or bonds or any other version.
Goes for any of those, yeah.
Yeah. So the market is really watching the total level of government debt rather than the excluding a capital budget level of debt at a particular moment in time. But on that, David, technically with the tax increases in 28 and 29, we would be running a surplus on day-to-day government budget by 2029.
Yeah, I'm very skeptical that we'll be running a surplus in 29. It's just such a big moving budget and so many moving parts that I think we'll probably be in deficit. Probably not a big deficit, but still will be in deficit. And so it would be great if we got to surplus and could actually start thinking about how you pay down some of the debt. But I'm still a bit skeptical that will happen, given his grand plans that he wants to do.
Let me talk about inflation for a second, because it's the inflation performance in the UK that's been really poor for a very long period of time. And the last government didn't pay enough cognizance to the threat of inflation and its actions. So I was looking at some numbers, and inflation has averaged 3.6% in the UK since the GFC. In the rest of the world, it starts with a 2. And inflationary expectations, according to Bank of England, is around 3.4%. So the consumer's kind of clocked this high rate of inflation, driving up real rates, but that with a spread premium on that makes life more difficult. Joe, in the equity world, in the equity market, are you seeing corporates having that degree of price flexibility, or is this something that is being driven from elsewhere? Is it more about energy costs and food costs as opposed to real price flexibility for companies?
Yeah, I suppose when you look at budget in 2024, that was certainly very unhelpful in terms of inflation, increased national insurance costs, and that was largely kind of passed on through higher prices. And then we have kind of the external factors as well, whether about higher energy costs. The kind of whole labour market setup in the UK is just quite unfavourable, whether it's national living wage, etc., higher labour costs. So it does feel like there's kind of a few pressures coming from, whether it's kind of been politically driven, kind of at home, or external factors as well, which have created various pressures for companies. And then generally, you will be seeing that coming through in terms of higher prices, which of course is just unhelpful as well.
That circle exists where corporates can and will pass through higher prices at the present moment in time. So that makes the prize of obtaining a lower long-term inflation rate much more difficult. David, would you give any credence to the idea that we could get our long-term inflation rate lower and thus Clearly, interest rates lower.
Well, I think it's entirely possible the UK could have a lower long-term inflation rate. I think the difficulty is that these things get baked in over a period of years, and it takes a period of years for them to change. And so even if we saw inflation come down, I still think the consumer would still be anchored a bit higher. And it would take several years of experiencing lower inflation. So I think the government needs to be very cognizant of not pushing through policies that not push up prices. And number two, also not doing much more to continue to push up wage inflation. As one thing that inflation always has to be supported by is by wage inflation. If you don't have wage inflation, people who don't make enough money, they will not, pay through the inflation because they can't afford to. They'll just spend less. And so I think it'll be very interesting to watch what they do with public sector wages over the next 12 to 24 months.
Yeah, it's been a critical element. And of course, that all feeds back to items such as the triple lock for pensions. And again, you get that overall fueling of costs going up. So let's focus on portfolios. As a result of what we saw yesterday, as a result of obviously with what we've heard about the new government over the last month or so, David, has that persuaded you to take a slightly different view on UK gilts and your positioning at the moment in the UK?
No, I think that we have a little bit of gilts in our European portfolios, but a very small amount. We think that you get paid a good premium to own gilts. I mean, they're the highest yielding out of the G7, or actually most of the developed world. They're the highest yielding governments. We think that their room to maneuver is quite limited. So you may see some volatility, but overall, I think you get paid for the risk that you're taking. So I don't think that changes. I think it'll be interesting to see how they, again, address the budget in the autumn. I think is what everybody will be focused on to see what the actual longer term plan is.
The budget does get delayed this year as it has been the last couple of years because the markets really haven't liked that at all. Jo, what about yourself? Because you've got that great switch between the FTSE and the 250 where one is predominantly international and one is predominantly domestic. Do you see anything here at the moment that makes you feel as if you would want to move at all towards the domestic market, which has underperformed the international FTSE 100?
Yeah, so you look at mid caps and the valuations do look very compelling on a long-term basis. They're actually yielding a premium to the FTSE 100 at the moment, about 4% versus about 3.5%, which is, it's pretty compelling. I suppose one thing to kind of think about though is is valuation enough? We do still obviously have these kind of risks in the UK, as we've talked about. We're kind of now going to wait for the budget and the 10-year plan to come out as well. So there is a risk that does just still create this uncertainty, which kind of holds the UK economy back and maybe holds investors back from putting money into UK assets. Certainly the valuation argument is there on a long-term basis, and we'll continue to look at opportunities within the mid-cap space. But just worth reminding, in terms of our equity income portfolio, we always commit to having a bias to large cap. That doesn't stop us looking down the market cap range.
For interesting yields in that FTSE 250 at the present moment in time.
Yes, exactly. Yeah, about 4% yield. And I mean, a lot of that does come from these very yield sensitive areas, be that real estate, which obviously is very dependent on the outlook for the gilt yields in the UK. So the two are very correlated and something to watch very closely.
Finally, let me put you both on the spot. And I appreciate that we are market operators and economists, and we think in terms of the world of its financial flows. Best guess for the next election date, Jo?
I think it really does depend in terms of how much momentum Burnham gets. He needs to get the electorate on his side. It's obviously been quite split. It would make no sense in going now. He said he's not going to do that, but obviously circumstances can change. He needs to get people on his side, whether it's addressing things like the cost of living measures, which we've seen today. Obviously, he's trying to do that. So if I had to hazard a guess, I'd say we're thinking August 29 is the very latest. So I think maybe a year before that, maybe 2028, summer 28.
I'll pencil you in for the summer of 28. David, what's your best guess?
I think there's a couple things going on. I think that if he remains in power, which I still think is an if, because he's done a lot of bringing in people from the center and the right and the left of the Labour Party, and I think many of the Labour MPs that supported him, which are more to the left, will not necessarily be that thrilled with that. So that will be interesting to watch that dynamic over the next couple of years. But I expect he'll wait as long as possible and kind of go in 29, early, kind of May, unless he sees a real bump in the polls, and then he might be opportunistic. But otherwise, I think he's talking about a 10-year plan. Just to lay out that 10-year plan and start getting things moving will take probably 5 years. So I think he needs more time to be able to demonstrate that he's done something before he goes back to electorate.
My tuppence halfpenny's worth, I think he goes in April next year, because I think he gets that bounce, David, that you're talking about. And you don't necessarily at that point get really held to account for the actions that you've taken. And you take, like, it's always like a football team. You take the new manager bounce over the January period when the fixtures are very congested, and you actually come out looking quite clever by early February. So I'm going to go for April 27, which of course is usefully before any tax increases will have kicked in as well.
So that would line up with the French election. That'll be quite exciting.
Yeah, it certainly would, wouldn't it? Yeah. I mean, next year is a huge year for elections right across Europe. You have the French, you have the Spanish, and perhaps even the UK one as well.
And don't forget Italy.
Absolutely. Yes. In fact, actually, all members of G7 in Europe will be having elections next year. Very good point. Very good point. As on the presumption the UK does. Jo, David, thank you very much indeed for this very fast update on what is a fast-moving situation. I'm sure we will come back and discuss again where we are in a month or two's time, but much appreciated.
Thank you.
Thank you.